Good afternoon, everyone. Today at 3:30, it's already 2:20, meaning 1 hour and 10 minutes from now, we have CPI. We're going to focus on the dollar. We have CPI on the dollar. Again, I know there is always a new person here. If you don't know what CPI means Consumer Price Index. So this is the measure this is whereby the US measures the power of consumers, the price change. Let me give you a clear example. If last month bread was costing maybe, let's say $1.2, if this month bread costs $1.5, it means the price of bread has increased by $0.3, which means that consumers are going to spend more money on bread. Now it cuts across all groceries. It cuts across fuel. It cuts on the gas, housing, and all that thing. So when you look at all households, they affect every citizen in the country, be it the president, be it the lowest person down, because they all eat. So if the price of bread increased, it means in the economy, people are going to spend more money on bread. It means if the whole grocery increases, it means homes or every home is going to spend more money. Meaning people are going to be stretched because they will need more money to sustain their life. So the moment there is a higher increase in the prices of goods and services, that means people are spending more money and all that, which creates inflation. Inflation is whereby there is so much money being spent within the country. People are spending more money on gas, or in Africa we call it petrol. Even if you don't own a car, it will affect you. Why? Because everything that you use in your home, it is delivered to the supermarket by a truck which uses fuel. So these things affect each and everyone. So in case we are looking at CPI for a month. Now we are looking at data of last month of March. Analysts, they are analysts, bankers, all these independent analysts, they are expecting, which is called forecast, they are expecting that the CPI is going to be higher by 0.3%. If the CPI data comes out, and it is lower than the forecast, it is 0.2%, it is 0.1%, it means there is less inflation, meaning the prices of goods and services actually didn't increase that much, meaning people didn't spend a lot of money on things, meaning there is no inflation. What does it mean for a dollar if you're trading a dollar? It means, first one thing you need to understand, once there is high inflation, what does the central bank do? They try to increase the interest rates. When they try to increase interest rates, it attracts more people to invest in the US bond market, in the dollar market of the US, which makes the dollar to buy. But if there is less inflation or no inflation, that is, if the data comes out lower than forecast, it means the dollar is going to sell. Why? Because the central bank is going to cut the rates instead of increasing them. So if this data comes out lower than the forecast, the dollar is going to be weak. It means if you are trading gold, you're going to buy the gold. If you're trading GBP USD, you're going to buy the GBP USD. If you're trading USD JPY, you're going to sell it. That is if the data comes out lower than the forecast. But if the opposite happens, if the forecast right now forecast is 0.3%. If it comes out that it is 0.45, even anything above it, it means there is high inflation in the US, which I expect. Let me explain why do I expect the data to come out higher. We have been having one thing, the war between US, Iran, and Israel, which has totally increased the price of fuel in every country. Be it in your country, wherever you are, the price of fuel has increased. So in the US, it increased by over 40%. So we are expecting the price of goods are going to be skyrocketing. So if this data comes out higher than expected, it means the dollar is going to be strong. There is high inflation in the US. The dollar is going to be strong, meaning if you're trading gold, you're selling it because the dollar is going to push down. It's going to take over the market. If you're trading GBP USD, you're going to sell it. If you're trading USD JPY, you're going to buy it. As simple as that. Let's come to the CPI of year, which is Y after Y. What does it mean? Last month, which is March, they normally look at March of this year, they compare it with March of 2025. They look at this data, they see, wait, did the prices of goods and services increase March of this year, or they reduced compared to the March of last year? If the data comes out, right now the forecast is 3.4%. If the data comes out and it is higher than the forecast, meaning the prices of goods and services this year 2020 in March were actually more expensive compared to the prices of goods and services last year in March, it means one thing. It means that we are looking at a market that is going to entirely trend to the upwards. The dollar is going to entirely take over by buying. You get my point? If the data comes out higher. If it comes out, it is maybe 3.3%, 3.2%, 3%, and all that. It means the dollar is going to generally going to be weak. Meaning you don't need to trade at 330. That data will guide you on the trend of the market. So this is what I had to share today. I hope you can go through it. And then if you have never been trained how to trade fundamentals and all that, my number is always in my bio. You can always reach out. We connect. Thank you.